The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past.
Howard Marks, a super investor you follow, has been talking about a big sea change happening in the US economy. This refers to a major turning point with significant effects. He's explained this idea in his investing memos, which analyze important market events. Marks argues that the past decade was marked by ultra-low interest rates and easy access to credit. This easy money era, fueled by quantitative easing, government buying bonds, went on for so long that people forgot what normal interest rates felt like. He believes this situation can't last forever and a major shift is underway. Let's see how this sea change is happening according to Marks in 2024.
In the period 09 through 13, the Fed took the Fed funds rate to zero to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world.
But it isn't an easy world now. It's true that things were easy with super low interest rates and everyone borrowing freely. Then the pandemic hit, the world shut down, and the economy stalled. Governments printed a lot of money, which caused inflation to jump. This forced the Federal Reserve to raise interest rates. So while some of us might think these higher rates are a big deal, Marks argues they're actually pretty normal. The problem is, the past 2 decades of ultra-low rates tricked everyone into thinking that was the standard. This shift to normal interest rates is causing some issues now because people aren't used to it. Marks even has a model in his mind where he considers these interest rates pretty normal. He says they're not high compared to what he's seen in his career. He says most of the problems we're facing today only seem like big problems because we got accustomed to super low interest rates, around 2 to 3% being the norm. That's what we've lived with for the past 2 decades. But if you take a broader look at historical interest rates, you'll see that 2% is actually quite low. It's actually a very stimulating rate, meaning it encourages borrowing and economic activity.
Rates are likely to be between 2 and 4, not between 0 and 2, the Fed funds rate. And, between 0 and 2 is an emergency measure. And, rates were, the Fed funds rate was 0 much of probably the majority of the time in the 09 to 21 period. And that's inappropriate. It stimulates. You can't live on a shot of adrenaline every morning for 13 years. And it does subsidize borrowers and penalize lenders and savers. And I would like to see a Fed get to a neutral position, which is neither stimulative nor restrictive. And I describe that as 2 to 4.
However, he discusses the impact of different Federal Reserve rates on returns. He says that if interest rates are higher, people who invest in credit instruments will have higher returns. Since he believes today's rates are not historically high, he thinks returns on credit investing will be higher than those in the recent past. This suggests that Howard Marks might prefer higher Federal Reserve rates. So, if you try to understand it all at once, then it means that for a long time, interest rates were super low, and this is why it became the new normal for everyone. Now, rates are going back up to what would historically be considered normal levels, not even particularly high. This is causing problems because people and businesses got used to cheap borrowing and took on a lot of debt. Mortgages, business loans, it's all hitting a snag because things got a little crazy during the easy money era. But here's an even bigger concern for Marks. This sea change is hitting the government hard. Just like everyone else, the government borrows money to fund things like social programs and infrastructure. They also have to pay interest on those loans. Now that rates are rising, the government is feeling the pinch. They have to refinance their existing debt at these much higher rates. In fact, the US government might be in the deepest trouble of all. Remember how Mark talked about people getting addicted to debt during the low interest rate period? Well, the US government has been doing the same thing for the past 2 decades. Let's see how that's playing out. For the past 2 decades, the US government has been spending more money than it brings in each year. This creates a gap they have to fill by borrowing more and more money, piling on debt. Since the last year the government had a surplus, brought in more than it spent, the debt has been steadily growing, especially in recent years with the pandemic response. This has pushed the US debt problem to the center stage, becoming a major concern for everyone.
If we reflect on the last, let's say, 10, 14 years, you would imagine that in a decade-long period of ultra-low interest rates, you would have had this explosion in leverage. There are several reasons for that, but this period's been quite odd because we then had the pandemic, which led to the strengthening of balance sheets for both corporates and households off the back of a monster fiscal transfer. And a question I think that Lisa and I hear a lot, Howard, is where is the leverage now? Where is the leverage now?
Well, we know that the leverage is in the government, that the government has taken on a lot of leverage as part of its rescue mechanism. We had 2 serious problems, the global financial crisis to kick off that low rate period you're talking about, and then the pandemic to bookend it. And in both cases, the Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt.
As we just said, the US government has been spending more than it brings in each year. So, to ease the pain, the government used a trick called quantitative easing. Here's how it works. The government sells a bunch of bonds, basically IOUs, and the Federal Reserve, the central bank, buys them. This injects money into the economy and helps in the short term, but it also creates more debt for the government to repay later. Normally, the Federal Reserve could just print more money to buy even more bonds and help the government out. But printing too much money leads to inflation, which is the bad kind of price increase where everything gets more expensive. Right now, inflation is a major problem, so the Federal Reserve can't just crank up the printing press. This puts the US government in a tough spot. Their debt pile is huge, and they can't keep borrowing more because they already spend more than they earn. Plus, when some of that existing debt comes due, they'll need to refinance it at these high interest rates. That means they'll have to spend even more money just to hold on to that debt, leaving them with less cash for other things. This is the big problem facing the US government right now.
Is it too simplistic to say if the increase in leverage has been on the sovereign balance sheet, that's where the risk is? How do you frame that? How do you think about that?
Well, first of all, I don't invest in sovereigns. And the trouble is that in sovereigns, other things matter. They don't, when we look at companies, we ask, do they make money? Will they make money? Will they be able to pay their debt?
Yeah.
The governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function.
And then they have the ability of extending the cycle at the same time. I think this is what I'm trying to get my head around. If they've absorbed basically the leverage that existed elsewhere,
yeah,
and they are less exposed to the challenges of companies that you would invest in, are you thinking of a much longer cycle as a consequence?
Well, I don't think governments can keep us aloft forever.
So here's the real problem, that governments can't just keep helping us out forever. Normally, to stimulate the economy in tough times, the US government might ask the Federal Reserve to buy new bonds from them. This injects money into the system and gets things going. However, right now, the Federal Reserve is focused on the opposite, taming inflation by raising interest rates. They're not interested in buying more bonds from the government because that would just make inflation worse. So, as Howard Marks says, the government and the Federal Reserve can't keep propping us up forever. Something has to change. Marks agrees with Ray Dalio that the solution lies in fixing the root of the problem, the US government's budget deficit. They have to spend less than they bring in. Otherwise, this debt issue will never go away.
Let's take the US government as an example of somebody that maybe should be bankrupt in some respects because we borrowed so much money. We have $32 trillion of debt. We're running an annual deficit. This year will be roughly $2 trillion. Are you worried about our ability to pay off this debt? And if we can't, will it devalue the dollar?
It's clearly worrisome. There's never been a bankruptcy of the U.S. or a country like it, so we don't know what's going to happen. Right now, the US dollar is what's called the reserve currency of the world, and we get to print them. And we can print, in the short run, we can print as many as we want. And as long as that's the case, we're not going to go under. It's like if you have an unlimited checking account, you can pay your credit card bills without limitation. We just don't know where it's going. That's the problem.
Things aren't looking great, that's for sure. But with all these challenges, what should investors do according to Howard Marks? That's what the next clip will explore. We'll look at his thoughts on investing in a time of higher interest rates.
So today's rates are not high historically, but they're certainly higher than we had from 09 through 21, which means the returns on credit investing, fixed income investing, bond investing, loan investing, will be higher than those in that period, which were, really poor.
So now you understand that higher interest rates are a double-edged sword. On one hand, they make bonds less attractive because the fixed interest payments they offer become less exciting compared to the higher returns that you can get elsewhere. On the other hand, higher interest rates benefit businesses that borrow money. It becomes cheaper for them to expand and grow. This can make stocks more attractive. However, Marks, who focuses on credit investing, think loans and bonds, argues that things get interesting when interest rates rise and stay high. Because as rates go up, so does the interest you get on your loans. This makes lending more profitable. At the same time, higher interest rates make it harder for companies to finance themselves, potentially slowing down their growth. This can lead investors to move their money out of stocks and into bonds. So while stocks are still an important part of investing, Howard Marks would recommend considering some credit investments, bonds, as interest rates rise. Let me know in the comments below if you've been buying bonds with the recent interest rate hikes. Also, if you're interested in learning more about investing, check out our videos. Thanks for watching. Like this video if you found it helpful and subscribe to our channel for more content. See you next time.